With this session, we're going to move into economy and what's happening in the business sector, in the markets. We have a provocative title, and I'm guessing that Prabal came up with that: money, markets, and mayhem. And we'll try to understand through the conversation. We have two esteemed panelists, experts in their areas, and they will help us understand what's going on in the country and the market in India currently. Tamal, starting with you, we have had a lot of stories about how the economy is growing very fast, and the GDP is also going up, and we've had the Modi government now in for the third consecutive term. But what do you think is the current state of the Indian economy, and how is it faring in terms of the highs, the lows, and possibly some of the challenges it faces?
Yeah, but we have to see the COVID as a context. So since then, till last year, growth was pretty rapid, and that was expected because from the base, what happened, 7% plus, and then this year, nothing new. I don't want to repeat all the numbers, etc. But it was pretty shocking. Q2 growth numbers 5.2, which has been revised now 5.4. And Q3 number is just about a week, less than a week old. 28th we got the number. It's on the expected line. Now you're all looking about Q4, Q3 because government started spending. That's what economists are interpreting. That's the driver. And our chief economic advisor said that Kumbh Mela will play a big role in lifting the numbers in Q4 because of demand creation. Now, going beyond the numbers, we need to see that if you look at the macroeconomic thing, there is nothing to be worried about as such, because our fiscal deficit is, the government is on course, and that path they are not deviating at all. Neither on the monetary side we have seen. In fact, monetary side had been too tight till now. So neither on the fiscal side nor on the monetary side we have many cracks to be seen. Of course, rupee is depreciating. Foreign exchange reserve is depreciating, bank credit is not going up. These are the ways of looking at things which are not so positive. But on the other side, if you look at it, these corporate balance sheets are pretty good. They're all their leverage has taken care of, the pretty sound balance sheets. And as far as the banking sector is concerned, again, bank balance sheets are pretty good. The bad loan, that dream has gone. It's less than 1% net NPAs, which has never happened before. So the health of both banking sector and corporate India is pretty good. But there are pockets of concern. But the overpowering thing at this point of time is the what we call it. In 2013 we saw the taper tantrum. Taper tantrum is that when the US Federal Reserve started putting a brake on the liquidity flow. That's what happened, and the entire world faced the music, including India. And now it's much bigger than taper tantrum, is the Trump tantrum. I don't want to I don't know, all of us last one day we are just glued to the television channel and that their conversation, it never happened. We could never see that. So that's this uncertainty is we don't know, because it's not economy, it's driven by politics at this point of time. I'm talking about the global politics. I'm not getting an exaggerated sense that we are staring at third world war and all sorts of things and all. But our prime minister rushed and had the meeting, etc. But if you see that, because your session is on the markets and economy, market did not react to that. He came back, and then after that, the biggest fall we saw on Friday. That's a separate story. Market we discuss later. But at this point of time, to summarize, there is no big concern as such at this point of time. There are issues like foreign exchange reserve, there are issues like rupee depreciating, there are issues like bank credit is not going up, so on and so forth. But overall, there is no huge concern. I think uncertainty, and that's a purely Trump-driven uncertainty. And other key factor in this twin factor that's in Indian economy, our domestic term playing out, is this lack of demand and the corporate India's unwillingness to invest. How long government will continue? Because the capex, we are all talking about post pandemic, the trigger for economic growth was the huge capex, but now government is slowing down. There is a limit to what extent government can do, and of course you have to see that government cannot deviate from the fiscal deficit path that which has been started out and all. So the corporate India needs to come in and invest, which is not happening. He's a better person to tell us why this is not happening. And other side of the coin is and they can also pretty well they can say that this is the reason, because the demand, there's no demand. I end here. Thank you.
Thanks, Tamal. According to Tamal, there's not much to worry about. But that makes me come to the point of why then the slump. Last Friday we saw, there was less trading, and consequently so many write-ups on, what's going on in the stock market, and what exactly is the situation, and why is it happening?
So Tamal actually indicated, he alluded about the politics of money and the politics of markets, right? So the politics of market and the culture of money is exactly what I think all of us are looking at. And the brute force is what I guess has been unleashed, from October or November onwards. It is something that was anticipated. It is something that is known. But I think there are a few things that we all need to understand quite clearly. If you look at the whole size of the global markets, right? The global market cap, as we all know, it's about $115 trillion. Out of that, more than 50% of the market cap is in the US. Right? So the US indeed is the largest market that we have ever known on this particular planet. And it continues to grow, and it continues to be, therefore, the brute force that it will actually unleash, whether to attract capital back or to send capital from. Right? So there is definitely going to be a huge dependence on how US itself behaves, both as a market and also as investors, right? So wherever there are pockets of opportunity where US investors believe that there is an opportunity in an emerging market, developing market, other developed markets, money comes out from there. Right. And we have seen in the last couple of months that the rising bond yields in the US is a very simple, rational way of saying that the money is leaving emerging markets. But I concur, with Tamal about have we put our house together, or are we putting our house together in order? And the answer seems to be yes, we are getting our act together. In terms of political stability, in terms of policy-related direction that we are able to offer, and markets like that certainty, in terms of deepening of the retail investing public community. Over the last 5-10 years, there has been a growing trend, whether directly or indirectly, when India retail or domestic investors are actually being an effective counterbalance to the foreigners. So if you recollect, at the start of this particular century, there used to be a complete notion about how much the FII money, as it was called earlier, can bring complete panic in the market. Of course, we do watch the headlines. We do get, influenced by the sentiment of the speed with which the FPIs have taken the money out in the last few months. But there is a reality that is in front of all of us, which is that the retail investors in India, and by retail I mean domestic investors in India, actually hold for the first time ever higher shareholding in Indian corporates than foreigners. Right? It has never happened. Right? So that does tell a story. That does tell a story in terms of who will drive it. Right? And how deep this market can be expected to grow. We do need foreign investors to invest, whether it is through FDI or through secondary market and stock market investments, but we also need participation by the domestic public, and that is visible whether you look at it at consumption whether you look at participation. I was reading somewhere that the rural demand and the rural participation through the smart phone connection is at an all-time high. 440 million people have internet connections in this country, and they will do something, right? They will do commerce, they'll do online commerce, they will do investments, they will do bank accounts, they will participate, right? And that is what is putting our act together right now. So I'm not concerned about whether we have the drivers in place. Obviously, like many of us in this room, I do get worried about the speed with which the markets move. More when it is down than when it is up. But yeah, let's keep talking.
So quite interesting. I think both our panelists have brought up the international impact. I think the impact of Trump, and we all know he's most likely going to stick around for another 4 years. He's unpredictable, and he will possibly continue to have an impact on Indian markets. You did suggest, few ways how we can counter that, and maybe look at alternatives. Tamal mentioned about contribution of corporate India. But I want to understand from both of you, how does the market situation currently impact the common man, a small investor, for example. And there are a lot of people here in the room. Do they need to worry or keep something in mind? How does it impact the common investor currently?
Emotion, sentiment is obviously the first reaction that all of us get influenced by, and some of us must have seen a very simple statistic that is put out by the mutual fund industry, which is the SIP stoppage ratio, right? Which means the number of SIP which have got discontinued in this entire market mayhem, as you may want to call it, in the last 60-70 days, right? So the stoppage ratio has gone up. So the immediate and the first reaction by a retail investor through SIPs has been a panic, right? And that does happen because it is emotion. I mean, one of the most common discussion that you will have either in a local train or anywhere else in any office is what's happening to the market, right? Do I book the loss? What do I do? So retail investors do behave in a manner where emotion and sentiments are going to drive it. Friday's market behavior is obviously troubling all of us, but keep track of how people are behaving. More importantly, these are also the times when one needs to understand a slightly longer term opportunity, which Tamal is talking about, which I'm also more confident about. If we can look beyond the next 60-90 days, these are also the levels or prices that we will not see again in a hurry.
Yeah, Amelia, I just want to put certain numbers in the context, like US market, as you rightly said, such a big market and all. Now see even how vulnerable the US market could be. But before that, what's happening in India at this point of time? The past 5 months, beginning in October, November, December, January, February, 5 months, the kind of fall Nifty has seen, there is no comparison in the history of Nifty. Nifty is much younger than Sensex. So that's the one part of it. Small caps and mid caps, I'll not talk about technicalities, but that they are already into bearish zone. As far as Nifty is concerned, another 1,000 points, if it drops, it will get to a bearish zone. Now, if we think that we get scared that, oh God, what is happening? I mean, everything is over. I mean, that you're talking about the retail investors and all, we'll lose our sleep, and there could be even much worse scenarios, people losing money. Look at what happened in US. Now, in the past 25 years, there are two occasions where market globally, particularly US, and of course including India, we had massive trouble. One is 2008 Lehman crisis, and much bigger was 2000. That's the internet bubble. Now, in the internal bubble thing, 2000 it happened. Between 1996 and 1998, Nasdaq got double. US, there are two, like our Nifty and BSE Sensex. There is Nasdaq and S&P 200, S&P 500. Now Nasdaq got doubled between 1996 and 8. 1999 Nasdaq was some 88% up, and the 5 months between November 1999 and March 2020 to 2020, when the slide started, Nasdaq was some 78 or 80% up. You see the run up. I'm just trying to figure out how the Nifty rose during the past 3-4 years. I'm just talking about that. There's no comparison, of course. There's much more. And then this crash came, and in the next 30 months, Nasdaq was just demolished. And it took 15 years for Nasdaq to get back to that level. From March 2020, in the next 30 months, the drop in Nasdaq, it took next 15 years to come back to that level. Can you imagine that? So even US market now, how long can it continue? At this point of time, US Federal Reserve stopped cutting rates. It's 4.5%. US Federal Reserve rate, so that makes the bond very attractive. Of course, thanks to Trump, equity market is pretty cool and all. So money is just like opposite of water. No, water flows down and money flows up, goes up. Okay, so but then when the tide turns, you see who is swimming naked. It's a much cliched phrase, but I'm just telling you. Will you be rest assured that Nasdaq and S&P 50 will go up and up and up because thanks to Trump? It may not. So we have to see in the historic context, like your previous. It's a wonderful, thanks to him. There's a wonderful context that history. Need to see the different prism and not only one side. So similarly, market also we need to see through different prism. Both emerging markets, Indian market, global markets, everything else, and also historically how it's been happening. So when it will look back and what is the lessons the individual investors, particularly the retail investors, need to see. So people have been talking about financialization. That's the buzzword in Indian context, at least still recently. Even now we are talking about that. Essentially, the savers are becoming investors. I call it equitization, getting into equity. But the point is how many of us actually know what we are doing. That's very critical. No? If you see during the COVID time, and trust you me, I'm not joking. I was not in the thick of COVID, just after 2021 beginning. I was on the Gujarat border, and I was finding out everybody was into cryptocurrency, or rather many of them into cryptocurrency without knowing anything. Just everywhere in the Dhanu area. I was there for 3 days I spent, and I was finding out everybody is into, almost 8 out of 10 guys I interface there with the auto rickshaw drivers or the provision stores or guys selling ice cream or vada pav and all. They're all playing on cryptocurrency. And very similar thing had been happening till about October, November. In the thing, it's very good that retail investors, we are seeing the demat accounts are going number up, SIP numbers up, people are going through SIP is different thing, but there are so many people a trader. My cook's husband, who was an auto rickshaw driver, I'm telling you the real life story. Yes, he became a trader and sitting at home and he was trading. You, without understanding anything, you get carried away, and like buying consumer goods, also there is BNPL, buy now pay later. That's also possible in the equity market. Because of the margin thing, you take at a high interest rate money, and your broker takes care of that. You pay only certain percentage, and your broker will do the rest of thing because you are just buy now pay later following that and all. So if the stock is going up, it's fine, you are making money. But if the stock is going down, then you have to sell your house. So I think what we did say, bubble is just too strong a word, but actually this financialization or savers become investors. I think at a very short span, it went to the extent probably there should have been a sort of little bit of thinking going into a little bit of counseling to them what we are doing, whether it's right or wrong, anything like that. So many of them or some of them, I'm not wishing them bad, but probably learning lessons what it should not be done. But having the last word, what he said is this equity play is not today and tomorrow and all. You are taking a risk. It's not FD that 8.5% is insured or 7.5% insured, and on that you pay tax, etc., etc. Here you don't know 7 or 70%. So you have to have patience, and if you are playing right, because this 10%, 15%, 20% drop, what you are saying, it's only half the story. There are many stocks which have been down 50, 60, 70%. I'm not getting into the retail. And they are all, people are going gung-ho over them. I'm not going to name them because I'm not an advisor, neither I don't want to discuss anything like that. But there are stocks which is just bitten down 50, 60, 70% down. So we need to think, just let's not get carried away. What happened in 2000 and 2021 chasing crypto, that happened in 2022, 23 until October, November 2024 chasing equity. I think there was a bit of a craze was there. We are learning lessons, and things will be better. That's it.
I think we are going through interesting times clearly, and possibly there is a churn in rural and middle class India. And I found a very interesting statistics. 5 years ago, there were probably about 30 million investors in India, and today there are about 180 million investors. So where are all these people coming from, and are we becoming, like, from possibly like a slightly risk averse society, are we suddenly becoming like more risk friendly?
Yeah, so of course, I mean that's the one way to to make sense out of this entire trend. But we must, for a moment, just think about the stock market as one of the indicators, and of course, then there is economy, right? And there is economy, which is what you and I do on a daily basis, and all of us participate or contribute to it. So this is the first time that in the third quarter we have crossed a GDP number of $1 trillion US. So I think there is a lot to celebrate about, right? So we are looking at these numbers in terms of the 6.3%, 6.4%, but we have delivered in the third quarter, which is the October to December 2024, $1 trillion US dollar
I think
GDP
that's a
number.
great thing. I think we
Which is a
should
great number, right?
celebrate that.
We are talking about, and we are enthusiastic about this narrative about $5 trillion economy. A $1 trillion per quarter is the first milestone that we should all celebrate about. The second thing that we should also take heart from is the fact that regardless of the way the markets have performed in the last 60 days, which is dramatic correction, there are no panics stories that you're hearing about from the financial community, right? Which in the past have been some of the bad stories that come out, right? A broker in this particular city, a broker in that particular town, a set of investors defaulting. Therefore, what I'm hinting towards is the fact that in the last 4, 5, 7 years, we have put our act together, our house in order, in terms of also creating a framework and creating a market infrastructure which is far more robust, which is far more receptive of market volatility. And it is important. It is important because going forward from here, these are the stories and these are the anecdotes that you and I will remember. What happened in January 2024, right? My broker actually delayed the payment, or my broker went down and under. Those stories are just completely out, right? Yeah. So our regulator, our market participants have both matured. Our framework and our regulation is supporting that the retail investors, domestic investors, investors of every form and shape are protected, right? So this is how the story needs to be built. So you can't grow a market in fits and starts. There need to be some decisive ways which point towards a direction where the markets will grow, which will obviously be a function how money flows or the economy behaves and the corporate earnings grow and all of that. So we must all take heart from the fact that regardless of the correction that we are in the midst of, we are actually behaving like a good mature market. right? In terms of how investors are not creating any kind of panic or are undergoing any kind of panic relating to settlements and relating to how safe their money is. Other than that, we must also take heart from the fact that last quarter's GDP growth, right, which is higher than what it was for July to September quarter, was on certain parameters, right? And what were those parameters, right? Our agriculture was all right. Our government spending is higher. Tamal talked about government actually doing its bit and continues to do its bit. Of course, it needs to be seen in terms of how private investments crowds in, so that there is that equal role that the private sector also plays in the capex cycle in terms of the enterprise and the growth of private sector. So all those things are there. We need not get completely pessimistic about it in terms of how the markets are behaving. Yeah.
Okay. Well, I just wanted to get back on the timeline a little bit, Tamal, because you mentioned earlier that it took the US markets 15 years to recover. What is your view on the Indian markets? Because this has been going on for the last few months. According to you, how long will this continue, and when do you see an upside?
I wish I knew the answer. I would have been the god. I mean, I don't think anybody knows. I don't invest in market directly. I just do it only through mutual fund. As a matter of policy, I don't do it. So it's for the first time probably, or in at least during in recent time this century. What is happening in market is driven by politics. When I mean the politics, I'm not talking about Indian politics. I'm talking about the global, the Trump. What is Trump doing is not. So this global financial crisis was a economic phenomena, business phenomena, banking phenomenon. 2020 was a different thing altogether. But now what is happening is primarily driven by Trump factors. So it's a huge uncertainty. We can do a great job in India, but still things may not work out, because if the money continues to flow back to the US, it's good story that we have got retail investors. They are putting in money, but still unfortunately they don't have enough muscle as of now to, if the FII outflow which you have been seeing in the past 5 months, if it continue, we do not know. Does that mean everything is over? Certainly not. I mean, we need to have patience. We need to watch. But certain things which, in the Indian context, it's important for the market to look up. One, of course, we will get to see how the December quarter earnings of corporate India, which was not so good in the past quarter, and so market was actually overpriced. So that has been coming down. I'm not getting into all the technicalities. The pricing part has been largely corrected, but we need to see how December quarter corporate India behaves, and then going forward in March. So depending on that, is some more correction due, or the correction is taken care of? People have been talking about, if you discussion, as you said, in the local trains and everywhere in Bombay, that how much Nifty will go down, another 1,000 points, another 1,500 points, or another 500 points. Typically, people have seen the market gurus. After that, they said in retrospect, we knew that this is going to happen. So market is something I don't think anybody knows. In the best and biggest investor globally, I don't think anybody knows. It's just in retrospect we can claim we knew it. That's one part of market. Other part of market is this: people will, they don't talk about loss. They will only talk about money they are making. As I speak, one of my friends who was a retired professor, and he used to call me every day till October, November, how much money he's making. Now, last few months, absolutely stopped. He's saying no. So I can see that. So market is as such that people are making money, they will flaunt about it, and people are losing money, they will keep quiet. So that's the thing. But overall, as I said, we need to see. It's as far as Indian countries is concerned, it's not that we are in a terrible shape. Macroeconomic stability is perfect. Corporate India's health is very very good. Deleverage, banking sector is pretty good, healthy. Bad loan is a bad dream, no more there. But certain things we need to see. One is, of course, the corporate earnings, December quarter and then March quarter. Is it catching up now? And then then the market will have the leeway to move up if it can, this thing as well. Why corporate India's earning is going down again, or is not up to the marks? Again, the factor is this: it's a chicken and egg theory. We have been talking about the consumption. We are all talking about how to boost the consumption. Why corporate India is not investing? One of the contributing factor probably they would be say that where is the consumption? Why should I invest and create more supply when there is no consumption? So it's a sort of we need to figure out what needs to be done. Other part, on the government part, there have been demand, and probably there's a legitimate demand that capital gains tax, because nowhere in any market the kind of capital gains that the FIIs are subject to, which is in Indian context. It's a politically not very I think it's a sensitive thing, but you're discussing market, so let me say that everybody says that. So look at this first. They are paying a tax which is nowhere in the world, which is not in any other market. And second is, because of the rupee depreciation. So if I'm an FII, I'm bringing dollar, I'm converting into rupee, and then again when it's taking back, I'm reconverting into dollar. So I am losing 5-7% in that conversion in a year's time, because rupee is in not a very good show and all. So other fact is this, to put it bluntly, is it time to actually, we see that let the rupee find its own level. Let's not, we have $550 plus foreign exchange reserve is good enough. So let not be concerned about so much. Let rupee find its own level. Or shall we create this artificial thing? Of course, we will say that we are ironing out the market volatility, etc., etc. But at the back of our mind, and we all know that it's actually protecting rupee. Now, going back to the FIIs thing, they are caught in the double-edged sword. Like once they are paying the tax, which is not anywhere else in the world, global markets. And second is, because of the currency depreciation, they are losing out. So is it time the government should take a look at it? Because if the market turnover is going down, if the buying is going down, then automatically the kind of money you are earning as a sort of tax will go down dramatically. That's what everybody is saying. So one needs to be, the structural issues could be to address at this point of time. Look at the capital gains tax. It's a technical part, but it will help a lot. It will encourage the thing, because combination of tax and depreciating currency is a big disincentive for the foreign investors, apart from what is the market scenario. And then corporate earnings, we need to see how is going up. Then, of course, we need to see how corporate is investing. That will be a good thing. And, of course, bringing back the consumption story down. And similar thing about the banking sector, you see the banking credit is not going up, which are again an indication of what is the corporate segment. Now, Reserve Bank of India did take a few policy decisions. One of them is to rein in the personal loans, etc. Because probably the RBI felt that money is getting into the stock market. People are raising money through this personal loan route and getting into the market. That's also probably true. That's why November 2023 RBI came down heavily. All this, raising the risk weightage, making money more expensive, etc. Now RBI has rolled back that thing. So things are getting back normalcy. Probably people have understood they will not do anything again, raising money from that formal system and putting money in the market, etc. But we need to see also the credit growth is going up. That will be an indication of the consumption story is back. So it's a little building blocks we need to be in place.
But you did suggest a lot of little ways that the government or the corporate can contribute in improving the markets. And I think you were saying earlier, if the situation goes on, then maybe there's more to be done. What can let's say the situation doesn't get better in the next 6 to 12 months, what more can the government do? Tamal suggested, taxes to FIIs, or what are the areas probably that the corporate India needs to invest more in to, help rise the markets?
I guess there will always be some quick fixes, and a capital gains tax is always one of those. Any tinkering around or abolishment of capital gains tax especially for the FIIs is going to be a big incentive and a big difference in terms of how India will look at foreign money for the first time in 25 years or longer. But I think one of the things that we are also seeing, which is something that is visible in the way the private sector behaves, or the enterprise of this country needs to continue to be the growth engine. Right. For example, what we have seen in the last 50, 60, 70 years is the entrepreneurship and the enterprise of the Indian companies, right? Private sector companies and all of that.
Unicorn stories and so much. That we
Yes, unicorn story is more, driven by, what's happening in the last 10 years, and is driven a little bit more about the startup culture and the tech entrepreneurs and the private equity and the venture capital. But generally speaking, the ethos of India has been the enterprise of people. Right, so anybody, whether it is a nukkad khaka shop or any business enterprise that has come about in the last 50, 70 years, that energy, that enterprise has been the bedrock of what we are seeing and what we are witnessing as great stories. Right, whether large cap companies which are homegrown or small cap companies or mid cap companies. Now, this particular ethos, this particular mindset should not change in the second and the third generation. Right, there is some reference that Uday Kotak made in the media recently about how he is not seeing the same level of energy in the younger generation, right? Because they seem to be in a mood of monetization. They seem to be in a mood of just letting money grow in a different way, not necessarily through business enterprise. So this element of how economy on the ground level will function is something that we all need to understand. I mean, more the business enterprises than you and I, who could be just financial investors, but because any let up in this particular energy is going to be the big paradigm shift, and that is not something that one would like to see as a part of the building block. This building block of Indian companies, Indian entrepreneurs working in making businesses successful needs to continue. Right, and that particular commitment, that particular energy, that particular innovation, that particular engagement needs to be a part of this growth engine that we are all talking about. Otherwise, you may have everything quite all right, but you will not have the businesses, you will not have the mindset, you will not have that commitment, you will not have that the energy to do Purusharth.
Yeah.
Right?
And the
You
5
have to do
trillion
Purusharth.
economy.
If you do
we
not
have
do
to
Purusharth, you cannot hope to grow.
Absolutely. Well, on that note, I'm going to open the floor for questions. So if you have any questions, please raise your hand and introduce yourself and ask your question, please.
My name is Ankur. I wish to know if the FIIs are taking their money, where are they putting, where are they investing right now? That's the first question. The second is, should I sell my real estate property and invest in the stock market now?
Our experts are here.
So, I mean, FIIs are taking money back to the US because US is the market where a lot of action is, and there is a tendency for the money to go back there. In terms of, I mean, one needs to know what was your motivation in terms of real estate investment. Is it for use? It was just for investment. Have you made money on that particular investment?
Wait, so it's just a thought that I could probably have something X plus something, but real estate does give a lot less return than a share market. Considering that markets are down today, I don't know how much they are going to go down, but if I sell it and invest in a stock market today, probably it's a period of return of 5 years or 10 years, something that I'm looking.
If you
With that perspective, I'm asking.
Yeah, so if you have a mindset and if you have the the long term approach to investing, and therefore are not bothered too much about when the market will bottom, and how quickly you would like to see a return on this particular investment, then you are in a good place. You are quite right that the capital appreciation that you may have seen in the real estate market may not repeat in a hurry. And again, the rental yield that you experience in a real estate, which is only an investment portfolio, is also quite quite unattractive. It is improved a little bit, but is usually it has been unattractive, and the only reason why people made money in real estate investment was because of the capital appreciation. So if the capital appreciation is going to be muted, the stock markets are looking attractive to you in terms of how the prices are or the valuation is, and you have a final long-term outlook of 5 to 7 years. Yeah, you could consider. I am considering.
I have a question, and I've been thinking about this for a long time. I think Mr. Bandyopadhyay alluded to it right at the beginning in his opening remarks, that if our Indian economic prospects are so good, there's a demographic dividend, everything, why doesn't the private sector invest in India? This is not something which is a one-year phenomenon or post-COVID phenomenon. It's like 10 years has been the same situation that the private sector does not invest. So what does that say about our economy, that for such a long time the private sector is not willing to?
Yeah, that's the puzzle. They're not. So we need to probably he's in a better position because of his professional thing. He could see, but understanding is this: yes, they are not excited. And of course, they would say they will find an excuse saying that this is not there is. I mean, we don't want to. There's why do you get into oversupply when the demand is not there, etc. But they're all excuses. But there are certain other things, other elements which exactly probably they are not finding it exciting. And anecdotally, we hear also the second or third generations entrepreneurs. Not massive big entrepreneurs, but say 100 crore, 200 crore, 300 crore worth of guys. They're even relocating to other geographies and all. So this is the question all of us are asking. It's a pretty sensitive question. We need to dig deep and find out what's the answer. Why is not that?
Sorry, the finance nerd in my head is just dancing. So my question is that from a macroeconomic point of view, right, we see that the private sector profitability in terms of MSME earnings, they're at its peak, and that's not commensurate with the wage rate increase. And we know that the wage rate increase leads to consumption spending, and consumption is the majority share of aggregate demand, which is about 60%. So we know that increasing the consumption would essentially take our GDP growth rate higher. We're forecasting a GDP rate of somewhere around 6.5 to 6.75, but we're far off from that 8% mark. So how do we solve for the consumption gap that's there in it?
So it's not I don't see this as a consumption gap. Obviously, we are looking at the rate of consumption spending, which, as I was saying earlier, in the third quarter actually was far better than what it was in the previous quarter. Right, so the consumption spending is one of the factors that helped us improve our GDP growth rate in the third quarter, right, to 6.9. And we are now forecasting that the full year GDP is going to be better than what we had forecasted earlier. Mahakumbh related consumption spending numbers, as they come along, one will see in the next next few weeks or a month's time. So is the consumption spending in terms of the growth as attractive as what we were all hoping for? The answer is no. Does it still remain one of the most important drivers for the GDP growth for India for this year as well as the next year? Answer is yes. You don't have to trust me just for what I'm saying, but you just have to look around and you will see it. right? So there is a lot that is visible, visible in terms of the consumption pattern itself, and that should, point towards, whether it is intact or not intact.
See this World Bank report, I think yesterday or day before yesterday it was released. It talked about India needs to grow real GDP growth 7.2%. I repeat, 7.2% every year till 2047 to get our dream developed market tag. So it's not an easy story to do. And other part, the consumption thing is this. It's a बहुत घिसा पीटा or cliche, whatever you call it in English, that so-called K-shaped recovery. Post-COVID, what we have done is, like many other economies in India also, rich got richer, but poor got poorer. So consumption is there, but where is the consumption? Consumption is there for the fancy watches. Consumption is there. You see how many top-end credit cards being launched in the last 6 months. But you see the overall credit card spend and the credit card spread. That tells you the story now. So in the premium end, you look at the Bombay real estate market. The flats, probably 25 crore plus, are the most sold flats over the past few years and all. So all this consumption is, large part of the consumption is concentrated in the upper end of the spectrum, and that's unfortunately the story of the K-shaped recovery, and that's what the fallout we are seeing now.
I was looking at some calculations by Professor Ashwin Damodaran. I was looking at some calculations by Professor Ashwin Damodaran, and he was saying that India's P is very high compared to other emerging markets. So is the sort of bearishness that we are currently seeing something that was already due, or is there something that we are doing wrong now? What is the reason for it? If we are already so highly overvalued, then why are we shocked at the market falling from last quarter or something like that?
So price to earnings multiple, or PE ratio, that you're talking about is obviously the most popular, but only one of the metric that one looks at to conclude whether the markets are overly or overvalued or not. I think if you look at historically, emerging markets and India in particular has always been a high PE multiple market, and PE multiples need to always be viewed in conjunction with the underlying growth of the corporate earnings, right, and the return on the capital that companies or such companies in India can actually deliver, right? So you cannot look at price PE multiples in isolation and say that 22 is very expensive or 23 is very expensive and it should be 17 or it should be 16. That's not the way it should ever be looked at. I believe that the underlying earnings growth rate and the return on capital or return on equity that the Indian corporate can deliver is more often than not justifying the higher PE multiple that Indian market usually command. What has happened in the last 2 months is obviously more of a politics of money and geopolitical efforts by White House and all of those things, because of which money has left in a hurry, money has left in larger magnitude, and the correction is obviously therefore visible in a very mathematical term, which is the price earning multiple. So is the market or are the prices better than what they were in September, October? Answer is yes, right? But does it mean that when the markets start growing, whether 3 months from now or 18 months hereafter, will we not see the same kind of multiples? No, nobody to guess and nobody to expect that it will remain attractive only when the prior PE multiples are lower. I hope you.
Yeah, please go ahead.
Thanks for being creative for this session. More very interesting questions here. You said that we should celebrate, or we celebrated more investors, retail investors, account opening and all. Do you see that the risk transfer from institutions, corporates to retail investors? Now we see this market because I think recently got in news also that this is the lowest promoters holding in India as of now. So how do you see this? And second question of SIP. People normally go for SIP route because they don't have time to go to the market, trade, or they want to save wealth grow over a period of time. So why do we see the SIP is getting seized or being stopped as of now? The market is going down. It's a good time. It will average out and probably over a period of time we will get a good wealth for the retail.
So the retail participation has been obviously more indirect in terms of participation through mutual funds and systematic investment planning, which is the SIP, is a phenomenon that has got understood and has delivered in the last 3-4 years for a common retail investor for the reason that you explained. What is at play is a simple in SIP, as you know, and what is at play is a simple compounding effect of money, right? Obviously, when the markets are in a particular trend, bullish trend, people are able to see the money make good returns, and SIP works quite well because you are not timing the market, you are not deciding the stocks, and you are just participating in that larger trend. Why is it that people have stopped their SIPs? It is just that knee-jerk reaction and the panic. Obviously, it is less to do with I do not have 1,000 rupees in my bank account, therefore I should not do my SIP. Right? So it's usually not that as the reason. It's essentially only the sentiment, the the emotion of the mutual fund that you have invested in, and the way the NAV may have behaved, and it is down 10%, it is down 18%, and that's what drives your decision to continue or not continue.
I think we'll have to make that our last question for this session.
Yeah, I think we're out of time, but I just wanted to thank all of you and our panelists, Vineet and Tamal, for sharing their knowledge, insights, giving all of us answers to our burning questions. So thank you so much. It was wonderful talking to both of you.